in 2008, when the housing market crashed, people were over leveraged. They didn't have enough of the safe money because they think all of their money has to go towards the rate of return. Yeah, a lot of it should, but not all of it, because when the market sucks, you're going to want dry powder on the sideline to go then pounce.
My risk tolerance changed once I became where I got to that $3,000 to $5,000 a month income. I was like, I can leave my job right now. I don't need this W-2 thing anymore. And I did actually do that.
Advisors are legally allowed to charge fees on money that has to go to the IRS. The IRS doesn't share in your fee structure. They don't share in your risk, but they share in all of the gain, all of it, for generations. Now, once you pass that retirement account to your spouse, now it's a single taxpayer, which increases taxes 20-30% on your single spouse. That's the condolences that you get from the IRS. Sorry, you're gonna pay more now. And then when your kids get that, they're forced to take that account and get it to zero in 10 years. Forcing them to take out more money than what you had probably planned on, pushing them into a higher tax bracket. Because everybody I talk to, are your kids successful? Oh yeah, our kids are doing great. All right, well, you're gonna leave a tax bomb for them.
My favorite Warren Buffett line is, we don't need to risk it to try to get somewhere further along.
What's up, and welcome to another episode of Cash Flow Conversations. Today, as usual, I have with me my good friend Glenn Yaney. Yanni, it's good to have you here, bro.
Thanks for having me. Excited to be on.
So we're going to talk about, this isn't a super long conversation, but this is one that I think is relevant because you hear about this strategy called buy, borrow, die. I mean, I have that, my shirts say that on the back.
Yep.
Buy, borrow, die. And the idea is you don't trigger taxation when you don't sell. But there's a few caveats that you need to have when you initiate this type of strategy. As I joke, always debt is my second favorite four-letter word. But how we utilize debt is more important than just understanding, debt's great. Debt's not great. Some debt is terrible. Some debt is good. But today we're going to talk about leveraging assets that are volatile. So things that go up and down in the market and using that as collateral. Sound good?
Sounds scary.
Sounds very scary. I'm going to start off with a quick story. I had a client, really cool guy. He got lucky enough to get involved with an IPO and made like $10 million. Okay, so he's got $10 million in the market. Rich. By a lot of people's standards, he's rich. A lot of people would say that'd be plenty of money. Well, what happens when you start making money like that is greed starts to come out. And they joke, pigs get fat and hogs get slaughtered. Yep. Well, he got a little greedy and he started to leverage his stock, meaning he would post his stock as collateral and you borrow money against the underlying stock. But the challenge is the underlying stock can go down. And Glenn, what happens when your collateral goes down in value?
From what I understand, the banks generally want to have a secure position. And if the security goes unsecured, they'll start calling the stock. Yeah.
They're going to say, look, your collateral, your underlying asset that we're using is now worth half of what it was. We only are going to lend half of what the account is. So if it's a $10 million account, let's say they're going to lend up to half of that. So they'll lend up to $5 million. Well, if the stock goes down, and if you're in one stock, that's super volatile. If the stock goes down, they're going to call the loan. So let's say you have a $10 million investment into this stock. What happened was the stock crashed. It lost more than 50%. He had a 50% margin loan on that thing. So he had a $5 million loan. They called the loan. He put the $5 million back in, and it all ended up going to zero.
It's terrible.
Terrible. So the guy had to keep working for a long time.
Yeah. One thing it kind of, so I guess it's kind of going the other direction a little bit, but even if you have like for us, we have lines of credits that are unsecured. So every year we have the bank, they send us an email asking us for proof. Our financials, our tax returns, seeing what we did. And what I can tell you is that if they find out that this year wasn't as good as last year, they're going to either lock up the line of credit or they'll call it. And that's always a risk as well. And that's kind of what I was thinking as you were talking. I was like, okay, so what's another solution that you can have that might not be as risky. And kind of what I'm doing is we have lines of credits, but it's still dictated by the bank and whether they think their collateral is safe or not.
Yeah. And so this guy ended up losing all this money. And what we discussed was, and this is for anybody who wants to retire at some point, anybody who's heard the word diversification. Diversification means uncorrelated assets. So when you are using a volatile asset as debt, you're inviting, depending on what you do with the cash, you're inviting a double-edged sword. Like if he took the money and invested in the market again, and the market didn't do well, so the money that he had invested was also going down, and then the underlying asset went down. So that's not diversification. When people talk about diversification, they think stocks and bonds. The problem with that is that I've never met a client that can explain the uncorrelated relationship between stocks and bonds. They think when stocks go up, bonds go down, and vice versa. They do sometimes, but not all the time. And your bond can still lose value. This is why I joke. I tell people that, a bond replacement, a great bond replacement, is something that's guaranteed never to go down. If you're trying to get 4% and you're paying fees on this, and it might trigger a tax, why wouldn't you use life insurance? Life insurance is going to get that rate of return with no tax, no fees, and it can't go down. So let's go one step further. I was talking to other people here just recently. They have a very cool strategy where they're investing all of their money inside of a brokerage account. And the idea is it's going to get 15%. And then they leverage the brokerage account to go pay for their bills because the leverage is only 5 or 6 or 7%. And you created this arbitrage where it's growing more than you're paying until it's not. When the market drops, now you have a negative arbitrage and you still owe the loan back. And they're saying, well, in order to fight that, we have cash equivalents. I said, cool, give me an idea of a cash equivalent. Very hard to understand. I don't think they understand it well. But he was saying how the people that they're learning from is teaching them how to use life insurance. But they kept using the word IUL, indexed universal life insurance. And everybody listening, there's different types of insurance products. Some are tied to the market and some are not. Well, IUL stands for indexed universal life insurance. Index meaning like an index in the market. So their cash equivalent to be this safety net against the market is directly tied to the market. So when the market goes down, terrible IUL agents will tell you that, well, you have a floor of 0. The index, the IUL can't go down. Yes, it can, because even if the market's down, you're still paying cost of insurance. And the older you get, the bigger that number is. There's still surrender charges. There's still fees. So the cash value can be reduced in the same year that you've just lost value in the market. That is directly correlated. It is not creating diversification. Any thoughts on that?
So real quick with that, because you're more familiar with it than I am, I would say that with IUL, what I've heard is say if like the market goes down, you actually don't lose any money is what the story is with IUL. But then don't they rebalance the next year, and that turns into where the cost, I don't know if it's called cost of insurance, but it's pretty much like they're paying for options or the insurances to offset the market. Is that what happens?
Hey everybody, quick interruption. This is Matt Love, your host of Cash Flow Conversations. And if you're interested in setting up your own cash flow structure so that you can save first and spend second and increase your net cash flow, please click the link below, set up your free one-on-one call where you can get me one-on-one, 30 minutes on a Zoom call, and we can go through where you are currently and where you want to end up. Our job at Cash Flow Architects is to show you how to increase your cash flow before retirement years so that you can create a life that you don't want to retire from. Ideally, in ways that are incentivized by the IRS. So we talk about taxes, cash flow, assets, all the good stuff. Click the link below, set up your free one-on-one call, and we'll see you there. They do that with annuities. And IUL, they can. Do they is another question. Because at the end of the day, an IUL policy, the insurance company pulls all the levers. They're in control of the cost of insurance. They're in control of the cap rates. So what if the market does 35%? You're not going to get 35. It's going to be capped at 10 or 11 or maybe 12. They can, and those are adjustable. The insurance company can change the cap rates depending on the market. They can change the participation rates. And some of these companies now have 200% participation rates. It's, it's absurd. It's not sustainable. No. And they'll illustrate 30, 40 years into the future using today's rates, cap rates, participation rates, bonus rates, assuming that it's not. And if you look at the language of an IUL policy, I pulled one up to talk about this. Watch this. Here's what the actual illustration says in the contract. This is the biggest problem that with IUL. The illustration assumes the currently illustrated non-guaranteed elements will continue unchanged. And then below that, it says, this is not likely to occur. So let's compare that then. Why would I use whole life insurance versus IUL? Because whole life is guaranteed by the insurance company not to go down. The cost of insurance is set at the time of application and when the policy is in force, guaranteed never to change. There is no market correlation. The profitability of whole life is directly tied to the profitability of the insurance company. Okay, so now I have a truly uncorrelated asset that I could leverage. And let's go one step further. If my IUL is directly connected to the market, whole life is not. The profitability or the growth of whole life is tied to the profitability of the insurance company. So I've done this for quite a while, and I talked to one of the CEOs of a $1 billion company, and I was asking him, why would you guys sell IUL? They sold an IUL product, and to me, you get some sketchy agents out there. There are some good agents that like IUL. For the life of me, I can't understand why, but a lot of the IUL agents just aren't that great. They're just trying to sell product. I said, why would you guys sell this IUL product? The best advisors that I've met in 15 years of experience don't touch that product. Why would you cater to this stuff? And his response was like, oh, well, duh. He goes, Matt, do you realize we as the insurance company push the risk onto the insured? If the market doesn't perform, we still get paid. Yep. We get to control the cost of insurance, the participation rates, the cap rates, the bonus rates. We get to pull the levers for the life of the contract. All of the profitability, so the risk is on the consumer. All of the profitability, it's like term insurance forever, basically. And then you're told to overfund it, and still the cost of insurance, like term insurance, is
1 year renewable term.
Yeah, exactly, dude.
So every year it goes up.
Yes, guaranteed. Yeah, and they can change that too. And that Transamerica got sued back in 2016. They got sued for changing the cost of insurance on grandma and grandpa. So they made a lawsuit against them. Which is good. But so the insurance company, that's a profitable product for the insurance company. So the insurance company makes money. How does whole life make money? How does that grow in value? The profitability of the insurance company. He goes, every IUL policy that we sell, those profits go directly to the bottom line and affect our dividend for your whole life policy. And I was like, oh my gosh, keep selling IUL. If it's profitable product to the insurance company, that only helps the boring whole life insurance product.
Yep.
Isn't that cool?
Yeah. There's some other things I like to think about with investing. It's like being the bread earner, the person that's bringing in the capital, it's like, how risky is our own income? And then how do we want to offset that? It's like the time that we need this liquidity is when, say, times might not be as good. And how certain do you want that liquidity to be? And for me, I like to keep mine in safe, liquid locations like life insurance to be able to take advantage of opportunity when times are uncertain. So if my money's tied up in a volatile asset, when those opportunities show up, I might be trying to hold on for dear life for those assets if I'm doing those things. So it's like, that's why for me, it's like I'm taking the risk in my own business, my own, I guess you could consider real estate investments, but at the same time, I'm offsetting the risk by putting it into a safe, secure location that's guaranteed to not go down and to consistently go up over time.
Exactly correct. My old firm had a lot of asset managers, and they would talk about how Matt, these clients, all of their money shouldn't be in whole life insurance. And I would say, I agree with you. I'm not an advocate for that at all. At all. They need assets outside of whole life, but those assets don't need to be managed by you. That went over like a fart in church. That offended
Yeah.
some people. It was in front of a room full of advisors getting paid to manage somebody else's money in the market when they can go buy an index fund for free. So that was the beginning of the downfall for that relationship. But I am steadfast in that opinion that if I believe that in diversification, if I believe that I want to take care of my family and have permission to invest and take risk, if I believe that my ability to create a bigger income is something that I want to lean into, then you're darn right. I'm going to have a lot of money in whole life insurance and then leverage that because it's guaranteed not to go down to go buy stuff. So let's talk about real estate, because real estate is kind of a volatile asset. I mean, the real estate can go down. Look at
It
right now,
can.
it's a little bit of a flat line right now. So in 2008, when the housing market crashed, people were over leveraged. They didn't have enough of the safe money because they think all of their money has to go towards the rate of return. Yeah, a lot of it should, but not all of it, because when the market sucks, you're going to want dry powder on the sideline to go then pounce. Like what I'm teaching these guys that I just talked to that are doing the strategy, the market is not guaranteed at 15% every year. And when the market's down, that's the time to infuse more capital. Buy low, sell high. Into what? I don't know. I don't care. What are you good at? This is part of your investor DNA. So
Yep.
in real estate, people are familiar with using other people's money. And when you leverage too much of other people's money and the market does go down, dude, you know how many people lost their houses, had to do short sales just to get rid of these properties? How the bank would take their home in 2008 and 2009 and 2010 because people couldn't keep up with those mortgages. So as a real estate investor, you personally, how do you approach all that?
So I like to, for me, what I like to do is I put all of my liquidity into my policy. And like right now, we're doing a refinance. It's closing the next day or so. And we're pulling out $167,000 out. And that 100% of it's going right back into my policy. And I will tell you that we're buying a property that's, we have to put $80,000 down, and that's going to happen within the next few days after that. So, but at the same time, we're still storing our capital to either pay premiums, which is building a bigger banking system for myself, or um, and then giving it more room to grow. Because what we're doing is I'm borrowing against assets to buy more cash flowing assets to be able to repay the loans back. So no longer is it me earning the income to pay the loans back. It's I'm buying, revenue sources, whether it could be through my business or it could be through buying a rental property. And that's how we're able to pay these loans back. So it's really, we have this asset in the background that's consistently growing, uninterrupted, while I'm able to take the risks in my own business, which is real estate. But there's other areas you can operate in. You can buy like dumpster rental, so that's one I've just recently looked into. And if you think about, we're going to borrow, I think dumpsters used to be 10,000 a pop. Like every dumpster was 10,000. Right now, I've been seeing them. They're about 2,500. And I've seen dumpster companies really like a one truck and 14 dumpsters being sold for about 150,000. And I think to myself, if you bought that truck, you would probably make about $30,000 a month revenue. So you're just buying assets to be able to produce revenue, to be able to funnel back to your system. And with life insurance, it's got great asset protection and also growth that's helps with taxes as well.
How much of your income do you, I mean, you don't have to say numbers, but it's a percentage. How much of your income do you throw into a policy?
So I was talking to somebody about this, but for me, I like to throw my extra cash flow in. So at the time when I got my first policy, it was about $5,000 a month. And what I have found is that you have windfalls throughout. You have random windfalls. Like it could be like a 30 to 40,000 this week. hopefully it will be about a 167,000,
Woohoo!
167,000.
Let's
Yeah. So it's
go.
like we're operating and we're constantly growing, and the numbers get bigger throughout time. Like if we think about ourselves when we're in our 20s and what we're making today, it's like what were we making then, and then would we be able to support our lifestyle today and that we made in our 20s, you know? So like me and Matt were talking about it earlier, like, or yesterday, like how much it costs to survive. And that's what we're doing. We're building out an inflation protected, we're growing our capital base, and we're also focusing on more revenue coming into our system to be able to build out more income is what we're doing.
I love it, dude. I agree with you. 5 years ago, we didn't make as much money. 5 years from now, we'll probably make more. That's the goal. And I know I spend more money today than I did 5 years ago. I have two more kids than
Definitely.
I did 5 years
Yeah.
ago.
Yeah.
Uh, and those things eat every single day, multiple times a day. Um, so understanding of true cash flow structure so that lifestyle creep doesn't just happen by happenstance
Exactly.
can really help increase your net cash flow, which is why I love doing what we do. Um, and having that capital. So let's go back to the debt against assets. If I'm going to take a loan against something, I don't want that to be a volatile asset. In 2008, there was people that made a lot of money, and that's 2008 to 2020. Real estate was a booming market. Interest rates were super low, and those who had dry powder on the sidelines, cash value, whole life insurance, are the ones that really made a phenomenal rate of return because they pounced when everybody else was having to sell. They were forced to sell. And when you're forced to do anything, it's usually not good. Choices are what make people successful. And life insurance is not like the end all be all. But my goodness, what an easy yes to say, all right, I'm going to take care of my family. I'm going to get guaranteed growth. Is it going to make me rich? Absolutely not. But it's there. So when the market sucks, now I can make the great rate of return with something else. Right?
100%. It's like I would say my whole life policy helps me sleep better at night. Like it's like I'm taking these risks in my life, like as an entrepreneur, business owner, whether you're a W-2 or a business owner. I think the people we're talking to are the people that are taking back ownership in their life. And how do you take back ownership? Is you just don't want people to tell you no when you need it. You know, so when somebody like when I'm doing two refinances right now, and it's painful. You're going through banks, you're asking for money, they're scrutinizing the collateral. It's like, what if how do we get ourselves to be in a position where you're going to have uh, the liquidity and availability to maybe not have to rely on the banks as much, or if you have a strong liquid foundation, the banks are going to be way less likely to tell you no. They're going to say this person's very responsible, they're secured, safe, secured, and then you can take the debt somewhere else. So for me, what I like to think of is as for debt is every debt investor or every loan or debt that I have is considered an investor in my wheelhouse. So like if it's from a bank, it's still considered an investor, and really how it's structured is how I pay it back. So like if it's amortized and if it's like a car loan payment, that's a bad amortization. So those are the debts I want to pay off quickly. But if it's like say like a 30-year loan on a house, those are like very long term, stretched out, for those investors aren't looking to be paid back anytime soon. So
Mm.
I'm like planting seeds over and over to where these assets are paying for the debt, and we're able to remain liquid while doing all this.
Yeah, that's a really good point. You look at the banks as investors for you because, which is really good. And there's a couple of, right, pros and cons. The cons are it's a bank and you have to deal with them, but the pros are interest rate. What you owe them is going to be a lot less than what you would pay out an investor. And typically, the bank has a schedule of repayment versus an investor who might want to get their money back sooner. Yeah, that's
Definitely.
good. That's good. When you talk about W two and W two people, you know, look, my ideal client is conservative. And I can't tell you how many times people say, "Man, I'm conservative. I'm conservative. I don't, I don't take a lot of risk." And I'll say, "Okay, explain to me what funds you have in your 401k or your IRA." And they have no clue. How is it conservative to invest in an asset that you have no idea what you're invested in, and you can't clearly describe the exit strategy? Because not only are you exposed to market risk, you're paying fees to somebody else because you don't want to take ownership, but you're exposing yourself to tax risk as well. There's market risk and there's tax risk, and you're paying somebody else to manage it so you don't have to think about it. That is not the ideal client. The ideal client is listening to this going, all right, I want to take control over my cash flow structure. I want to understand how to leverage good debt to buy, ideally, cash flowing assets that are incentivized by the IRS, which, by the way, there's 70,000 pages in the tax code that talk about how to not pay them. The whole tax code is all around here's how to get around taxes and different moves that you can do. And it's incentivized by helping the economy and your family. Yeah. So those W-2 earners that don't want to understand debt, good luck. You're going to be subject to whatever the market gives you without taking control or ownership.
Also, with the W-2 earner, because I was definitely one of them, I was there for 10 years. For me, I made about $150,000 a year, and I was always afraid that they were gonna like remove me. Like this was even before AI, but this was like when they were like, "This guy's making too much. We need to find somebody to make less. He's not going to work out in any other positions. We're just going to cross his name off this list." And that's kind of how I used to think all the time. And I think that I've always felt that way when I was working at my old employer, which they treated me very well. But I would say that I always felt like the next day was the day they were going to fire me. And if you think about risk and how you're paying your bills through your earned income, it's one income source that could be wiped off. They could cross your name off the line and you're no longer working there. They'll give you a 6 month severance pay, and if you're lucky, and then hopefully you can figure out a job that can make more. But whenever we're building out our liquidity of ownership, we're creating where we're trying to take back things in our life, the banking function, or even taking back, creating new income sources. And it's like, this is where we're lowering risks as we're increasing income sources somewhere else. So now if I manage to, I buy an asset that starts producing $1,000 a month. If I'm making, say 12,000, we'll just say $10,000 a month. I just offset 10% of my pay somewhere else. So now it just takes a little bit of pressure off. And then for me, my risk tolerance changed once I became where I got to that $3,000 to $5,000 a month income. My risk tolerance changed where I was like, I can leave my job right now. I don't need this W-2 thing anymore.
Yeah.
And I did actually do that. I ended up getting, $100,000 cash in my bank account, and I was at $5,000 a month of real estate income. And it made it a lot easier to take the next steps to grow where I wanted to go.
Yeah. That's beautiful, man. I love it. Taking
Yep.
control. So the key takeaways, and we'll wrap this up. Volatile assets like a brokerage account can be used as leverage. Usually there's a limit on how much leverage you can actually pull. From the people that I study from and learn from, most of the time, people shouldn't take more than 50% most of the time. And of all of your invested assets, anywhere from 20, 30, maybe even 40% should be completely uncorrelated with the market or the volatile asset that you're borrowing against. So if you have $1 million, that means you have 200,000 to 400,000 sitting in whole life insurance cash value that's guaranteed not to go down. So when the market does crash, you have access to capital or that dry powder to go pounce when everybody else is running for the hills. Depending on age would help dictate whether you're 20% into policies versus 40%. I always look at cash flow. And if I can get 20 to 30% of my income flowing through a policy, that's a phenomenal way to kickstart my investable capital. Glenn, any final thoughts on leverage and volatile assets before we sign off?
My favorite Warren Buffett line is, don't risk something you have in need for something you don't have and you don't need. And that's kind of like exactly with what you were just saying. Like we have this asset that we need and we for the future. We don't need to risk it to try to get somewhere further along. And I think that when things hit the fan, it turns into, you're like, what am I going to do now? I'm going to lose the thing I have and need for something I don't have and I don't need. And I have it. I had it used to have it on my wall at my office, and it's a great line from Warren Buffett.
I love it, dude. What a great way to end this. All right, bro. Thanks for joining me. And everyone listening, make sure you click that subscribe button. And if you want to figure out how to set up your own cash flow structure, schedule a call with Glenn and myself. There's a link in the description, one-on-one cash flow conversation where absolutely free. We'll talk about where you are, where you want to end up, and we'll show you the exact system that we use for clients all over the country so that they can capture their wealth and increase their net cash flow without increasing their risk. So thank you for listening. Hit that subscribe button, and we'll see you next time. Thanks, Glenn.
Awesome.